On the morning of September 15, 2008, employees began walking out of Lehman Brothers carrying cardboard boxes. Some held family photographs, others carried folders, coffee mugs, and whatever personal belongings they had managed to collect from their desks. Behind them stood the headquarters of one of the most powerful investment banks on Wall Street. Lehman Brothers had survived wars, depressions, market crashes, and more than a century and a half of economic change. Now it was bankrupt. Television networks interrupted their normal programming. Markets around the world began falling. Investors panicked. Politicians demanded answers. Within days, governments and central banks would be forced into extraordinary interventions simply to prevent the financial system from freezing completely. For millions of people watching the images on television, this seemed like the moment the 2008 financial crisis began. But it wasn't. By the time those employees walked onto the street carrying their boxes, the American economy was already in recession. Another major investment bank had nearly collapsed months earlier. Mortgage companies had already failed. House prices had been falling. Credit markets had been breaking down. And investors had already begun running from parts of the financial system that most ordinary people did not even know existed. Lehman Brothers did not create the machine that caused the crisis. It was the moment that machine finally became impossible to ignore. To understand how one bankruptcy could threaten banks, businesses, pension funds, homeowners, workers, and governments around the world, we have to leave Wall Street. We have to leave the skyscrapers, trading floors, and television screens, and go back to something much more ordinary: the American house. For generations, buying a home had been one of the central ideas of American middle-class life. A family saved money for a down payment. A bank examined their income, employment, debts, and ability to repay. The bank issued a mortgage. The family made monthly payments. And because the bank often kept that mortgage on its own books, the bank had a strong reason to care whether the borrower could actually repay the loan. If the borrower failed, the bank suffered. It was not a perfect system, but the incentives were relatively easy to understand. Then the financial system changed. Mortgages increasingly stopped being loans that stayed between one homeowner and one bank. Instead, they became raw material for Wall Street. A lender could issue a mortgage and then sell it. That mortgage could be combined with hundreds or thousands of other mortgages. Those payments could be bundled together into a mortgage-backed security. The security could then be divided into different layers, often called tranches, designed to offer different levels of risk and return. The safest-looking layers could receive extremely high credit ratings, and those securities could be sold to investors around the world. A teacher's pension fund, a European bank, an insurance company, a hedge fund, a university endowment. Money from all over the world could now flow into American mortgages. At first, this looked like financial progress. Banks could make more loans because they no longer needed to keep every mortgage. Investors received new assets that appeared to offer attractive returns. Home ownership expanded. Credit became easier to obtain, and because house prices kept rising, the entire system appeared remarkably safe. If a homeowner struggled to make payments, perhaps the house could be sold. If the value of the property had increased, the borrower might refinance. If one mortgage failed, it was only one loan inside a giant pool containing thousands of others. The logic seemed convincing, but hidden inside that logic was an assumption. House prices could not fall everywhere at once. During the late 1990s and especially the early 2000s, American housing prices rose dramatically. In some cities, prices doubled. People who bought houses watched their wealth increase on paper. Homeowners refinanced. Investors bought second homes. Developers built new subdivisions. Television programs celebrated house flipping. Real estate became more than shelter. It became an investment strategy. And as prices continued to rise, lenders became increasingly confident that even risky loans could survive. That confidence changed the mortgage business. Imagine a traditional bank that expects to hold your mortgage for 30 years. That bank cares deeply about whether you can repay it. Now imagine a lender that expects to sell your mortgage a few weeks after issuing it. The incentives are different. The lender may still care about quality. But the lender is also being paid for producing loans. Mortgage brokers earn fees. Originators earn fees. Investment banks need mortgages to package into securities. Investors want more securities. The financial machine becomes hungry for new loans, and by the middle of the decade, the machine was consuming mortgages at enormous speed. Subprime lending expanded. These were loans made to borrowers with weaker credit histories or higher financial risks. Other mortgages required less documentation of income. Some borrowers made very small down payments. Some loans began with low introductory interest rates that could later reset higher. In certain cases, borrowers were qualified based less on whether they could comfortably afford the loan over many years, and more on the belief that rising property values would provide an escape. As long as house prices kept rising, many problems could be postponed. A borrower could refinance. A lender could sell the mortgage. An investor could rely on diversification. Everyone could move the risk somewhere else, or at least everyone believed they could. By 2006, enormous portions of subprime mortgages were being securitized. A mortgage issued in California might be sold, bundled, sliced into financial products, rated in New York, insured through derivatives, purchased by a bank in Germany, and financed using money borrowed overnight. The person living inside the house might never know any of this existed. That was the strange transformation at the center of the crisis. A simple monthly mortgage payment had become part of a global chain of financial promises. And the chain was becoming more complicated. Mortgage-backed securities were only the beginning. Wall Street created collateralized debt obligations, or CDOs. These products could contain pieces of mortgage securities and other debts. Once again, the cash flows could be divided into layers. The upper layers might receive high credit ratings. That mattered because many large institutional investors were restricted in what they were allowed to buy. A pension fund might not be allowed to gamble on obviously risky debt. But if a structured product carried a top rating, it could appear safe enough to purchase. This created one of the strangest features of the boom. Relatively risky mortgages could enter one end of the financial machine, and highly rated securities could emerge from the other. It did not mean every mortgage inside the system was bad. Most homeowners continued making their payments. And not every security was equally dangerous. But the system increasingly depended on mathematical models, historical assumptions, credit ratings, and the belief that large numbers of housing markets would not decline together. Risk had not disappeared. It had been rearranged. And because it had been rearranged so many times, it became difficult to see where that risk actually was. The complexity created confidence, but it also created blindness. Then came leverage. This is one of the most important ideas in the entire story. Imagine you have $3 of your own money. You borrow $97. Now you control $100 of assets. If those assets rise slightly in value, your return on your original $3 can be enormous. But if those assets fall only a few %, your own money can disappear. That is leverage. It does not create losses by itself. It magnifies them. But, during the years before the crisis, major financial institutions operated with large amounts of borrowed money, and some of that borrowing was extremely short-term. This brings us to the part of the financial system most people never saw. The shadow banking system. Traditional banks take deposits. People put money into checking or savings accounts. Governments regulate those institutions closely, and deposits are often insured. But outside traditional banking, a huge network had developed, involving investment banks, money market funds, securities dealers, hedge funds, structured investment vehicles, and other institutions. They performed many bank-like functions. They borrowed. They lent. They created credit. But much of their funding came from markets rather than ordinary insured deposits. One of the most important markets was called repo, short for repurchase agreement. A simplified version worked like this. A financial institution needed cash. It temporarily gave securities to another institution as collateral. In exchange, it received money. Sometimes that borrowing lasted only one day. The next day, the transaction could be renewed, then renewed again, and again. Imagine a giant financial institution owning tens of billions of dollars in long-term assets, while depending on lenders agreeing to continue financing those assets tomorrow morning. That works beautifully when everyone trusts the collateral. But what happens if tomorrow's lender says no? That question would eventually become more important than whether individual homeowners could make their monthly payments. Because a modern financial run does not always look like crowds lining up outside a bank. Sometimes it is invisible. It happens when institutional investors stop lending, when lenders demand more collateral, when overnight funding disappears, when a firm that looked healthy yesterday cannot obtain enough cash to survive today, and by 2007, that process had already begun. The first cracks appeared in housing. House prices stopped rising as quickly. Then, in many places, they began falling. For homeowners who depended on refinancing, this changed everything. A borrower who had taken an adjustable-rate mortgage might suddenly face higher monthly payments, but the house was no longer worth enough to refinance easily. Defaults increased. Subprime mortgage delinquencies climbed. Lenders began failing. In April 2007, New Century Financial, one of the largest subprime mortgage lenders in the United States, filed for bankruptcy. This was not Lehman Brothers. It did not dominate global headlines for weeks, but it was a warning. The mortgage machine was beginning to break at its source. Then investors started asking a dangerous question. What exactly is inside these mortgage securities? That question sounds simple, but the answer was not. A security might contain thousands of mortgages. A CDO might contain pieces of many mortgage securities. Another product might contain exposure to those CDOs. Different institutions might have bought credit default swaps connected to the same underlying assets. Suddenly, the financial world's great innovation became its greatest weakness. Nobody knew exactly where the losses were. And if you do not know which institution is carrying the risk, you begin distrusting all of them. During the summer of 2007, stress spread into short-term credit markets. Investors pulled money from asset-backed commercial paper. Securitization slowed sharply. Funding became harder to obtain. Central banks intervened to provide liquidity. More than a year before Lehman Brothers failed, parts of the financial system were already experiencing something that looked remarkably like a bank run. But there were no crowds outside marble buildings, no people shouting at tellers. The run was taking place between computers, trading desks, money market funds, and institutional lenders. This is where the hidden beginning of the crisis becomes visible. The crisis was not born on September 15, 2008. By the summer of 2007, confidence inside important financial markets was already deteriorating. And once confidence disappears from a highly leveraged system, small losses can become large problems. Large problems can become liquidity crises. And liquidity crises can become failures. In March 2008, that danger reached Bear Stearns. Bear Stearns was one of Wall Street's most important investment banks. It had survived the Great Depression. It had enormous positions in securities markets, but its survival depended heavily on confidence and short-term funding. Rumors spread. Counterparties became nervous. Lenders pulled back. And within days, a giant institution was running out of cash. The Federal Reserve helped arrange an emergency deal in which J.P. Morgan Chase acquired Bear Stearns. The message to Wall Street should have been terrifying. A major investment bank could collapse not necessarily because every asset it owned had become worthless, but because the market no longer trusted it enough to keep providing funding. The question immediately became obvious. If Bear Stearns could fall this quickly, who was next? For several months, markets stabilized somewhat. But the underlying problems remained. Housing continued weakening. Mortgage losses continued rising. Financial institutions tried to raise new capital. Banks wrote down billions in losses. Confidence remained fragile. Then the crisis moved into the giant government-sponsored mortgage companies, Fannie Mae and Freddie Mac. These firms stood behind enormous amounts of American mortgage debt. By September 2008, the U.S. government placed them into conservatorship. Think about what had happened by this point. Mortgage lenders had failed. Securitization markets had frozen. Short-term funding markets had experienced runs. Bear Stearns had nearly collapsed. Fannie Mae and Freddie Mac had required government intervention. And the American economy had already entered recession. Lehman Brothers was still alive. The famous beginning had not happened yet. But the crisis was already everywhere. Lehman was becoming increasingly vulnerable. The firm had large exposures to commercial real estate and mortgage-related assets. Investors questioned the value of those holdings. Lehman attempted to raise capital. It tried to sell assets. Its share price collapsed. Confidence evaporated. Later investigations would reveal controversial accounting practices, including transactions known as Repo 105, that temporarily reduced the amount of leverage Lehman appeared to report around certain reporting dates. But accounting tricks did not create the entire financial crisis. They revealed something else. The pressure inside Lehman had become extreme. By September 2008, government officials and Wall Street executives gathered for an extraordinary weekend of negotiations. They searched for a buyer. Bank of America considered Lehman, but ultimately moved toward Merrill Lynch instead. Barclays was interested, but faced obstacles. No rescue came together. And before dawn on Monday, September 15th, Lehman Brothers filed for bankruptcy. This is the moment everyone remembers. The boxes, the employees, the cameras, the headlines. But the most important part of Lehman's collapse was not the bankruptcy itself. It was what happened next. Lehman was connected to institutions across the world. It owed money. It was owed money. Its securities were used as collateral. Its commercial paper was held by money market funds. It participated in derivatives markets. Its failure forced thousands of institutions to suddenly ask the same question they had been asking since 2007. Who is safe? The answer was becoming impossible to know. One day after Lehman's bankruptcy, another giant institution was in danger. AIG, American International Group, was one of the largest insurance companies in the world. But a part of the company had written enormous amounts of protection through credit default swaps. These contracts were designed to compensate investors if certain securities suffered losses or defaults. During the boom, selling this protection appeared profitable. But when mortgage-related securities deteriorated and credit ratings fell, AIG faced huge collateral demands. The company could not easily meet them. The U.S. government concluded that allowing AIG to fail could spread chaos through the financial system. So AIG was rescued. Now the panic spread into something even more ordinary looking. Money market funds. For decades, Americans had treated money market funds almost like extremely safe places to keep cash. Then the Reserve Primary Fund revealed that it held Lehman commercial paper. After Lehman failed, the fund's assets fell below the value investors expected. It broke the buck. That phrase frightened investors. Money rushed out of prime money market funds. Suddenly the panic was threatening one of the key sources of short-term financing for ordinary companies. This is the moment the crisis stopped being only a Wall Street story. Companies use short-term credit to finance normal operations. Payroll, inventory, suppliers, everyday business. If those credit markets freeze, even companies with nothing to do with subprime mortgages can suffer. The chain was now complete. A homeowner in Nevada misses mortgage payments. Mortgage securities lose value. Financial institutions report losses. Lenders question collateral. Short-term funding disappears. Highly leveraged firms are forced to sell assets. Prices fall further. More collateral is demanded. A major bank fails. Money market funds panic. Corporate credit freezes. Businesses cut investment. Workers lose jobs. Consumers reduce spending. The housing crisis becomes a banking crisis. The banking crisis becomes a credit crisis. The credit crisis becomes an economic crisis. And the economic crisis crosses oceans. European banks had bought American mortgage securities. Global investors were exposed to Wall Street. International trade collapsed. Factories slowed. Governments intervened. Unemployment surged. Households that had never purchased a subprime mortgage and never owned a Wall Street security still suffered. Some lost jobs. Others lost homes. Retirement accounts fell. Businesses disappeared. Families postponed plans they had spent years preparing for. And this is why the popular memory of 2008 can be misleading. We remember the spectacular moment. Lehman Brothers. But history often begins long before the moment television cameras arrive. The American recession had officially begun in December 2007, 9 months before Lehman's bankruptcy. By then, housing had already turned. Mortgage lending had deteriorated. Financial products had spread housing risk around the world. Leverage had magnified that risk. The shadow banking system had created dependence on short-term confidence. And important credit markets had already begun experiencing runs. Lehman mattered enormously. Its failure turned fear into panic. It damaged confidence at exactly the moment confidence had become the financial system's most important asset. But Lehman did not invent subprime mortgages. It did not create securitization. It did not build the entire shadow banking system. It did not create excessive leverage across Wall Street. It did not convince investors that complex securities were almost perfectly safe. And it did not create the belief that rising house prices could make weak loans harmless. Those forces had been developing for years. No single group created the crisis alone. Economists still debate how much responsibility belonged to low interest rates, global capital flows, government housing policy, financial regulation, rating agencies, mortgage lenders, Wall Street firms, investors, borrowers, and the larger culture of the housing boom. But one conclusion is difficult to escape. The disaster was created by a system in which many different actors could make individually profitable decisions while collectively increasing the danger. The mortgage broker could earn a fee. The lender could sell the loan. The investment bank could package it. The rating agency could rate it. The investor could buy it. The insurer could sell protection against it. The institution could borrow against it. And as long as prices kept rising and credit kept flowing, almost everyone could believe the machine was working. The weakness appeared only when the direction changed. When house prices stopped rising, refinancing became harder. When defaults increased, securities became questionable. When securities became questionable, collateral became questionable. When collateral became questionable, lenders became nervous. When lenders became nervous, funding disappeared. And when funding disappeared, institutions discovered that assets worth billions on paper could not always produce the cash needed tomorrow morning. That was the real architecture of the crisis. Not one bad bank. Not one bad borrower. Not one bad mortgage. A network of promises built on confidence. And once enough people stopped believing those promises, the system began collapsing under its own weight. Return to September 15, 2008. Look again at the employees carrying cardboard boxes from Lehman Brothers. The image feels different now. At first, it looked like the beginning, but it was actually the reveal. The moment years of hidden risk became visible to the entire world. The beginning had been quieter. It had happened in mortgage offices, in suburban developments, in spreadsheets, inside rating models, on trading desks, inside overnight funding markets, inside securities that few ordinary people had ever heard of. By the time Lehman Brothers fell, the crisis had already been unfolding for more than a year, and the machine that made the collapse so dangerous had been built over much longer. Lehman Brothers was not the beginning of the 2008 financial crisis. It was the detonation. The hidden beginning had already happened, and the world only recognized it when it was too late.